Hey, what's going on YouTube, and welcome back to Tech Conversations. I am your host Guillermo. It is April 6th. Let me know in the comment section below how you guys are doing today. As you can see, the market is starting to dip, but we're still green, up $100 today, or about 0.1% so far. So we'll see what the rest of the day brings us. Now, one quick thing, guys, we're almost at 100,000 subscribers, which is just insane. Thank you all so much for your support. I really appreciate it. And so because of that, I do want to do a giveaway once we reach 100,000. So if you'd like to enter that giveaway, all you need to do is hit the like button down below. Make sure you subscribe to this channel and let me know in the comment section below what your favorite stock in the stock market is right now. Again, thank you guys so much. Now in today's video, I want to talk about a very powerful strategy that we can implement that's very easy to understand, very easy to set up, and also very cheap. So we'll see with just a few dollars, we can potentially make some really big returns. Let me know in the comment section below if any of you guys are utilizing this strategy and with which stocks. So the goal from this strategy is to profit from a neutral or directional stock price move with very limited risk if the stock goes in the wrong direction. Again, it's going to be very cheap, so our risk is going to be very limited, but we do want to find a stock that is trading sideways, that's staying within a defined range. And so in other words, a stock that's not very volatile. So the stock I'm going to be using for this demo here is going to be HMC Honda. Okay, and I'm not telling you to use this stock. This is just an example. If you take a look here at Honda in the last month, really hasn't moved a whole lot. So this is one of those stocks that kind of trade sideways for the most part. Now, I will talk about what some risks are when it comes to these types of stocks at the end of the video. So make sure you stay around for that. So make sure that you've enabled options trading in your settings so that you're able to trade options. And let's head on over to the options for Honda. So here we are in the options. So the way this strategy is going to work is that we're going to buy and sell the same type of option. So call or put. We're going to focus on calls in today's video for the same stock. And we're going to choose the same strike for both of these contracts, but with different expiration dates. So let me actually give you guys here an example. So we're going to go out, let's say a month here or two. So let's go to the next available expiration date. So we'll go to May 21st. So first we want to sell our call option. Okay, so we're going to sell a call. Now the expiration date that we want, or the strike price that we want to choose here, should be the price that you think Honda will be at by this expiration date. So on May 21st, what price do I think Honda will be at? That's the strike price I want to choose. So let's just say, again, this is just an example, that I think Honda will be $25 on May 21st. That's the strike price I would choose. And so I'm going to sell this call right here. And remember, for selling this call, I'm going to receive $4.70 per share. Each one of these contracts controls 100 shares. I'm going to receive $470 as a premium. So I'm going to click on this. I'm going to receive $470. Now we also need to buy another option that's of the same type. So buy another call, which is going to have the same strike price, but a further out expiration date. So I'm going to go here to the expiration date. I'm going to go to the next available expiration date, so July 16th. And I'm going to buy a call this time. And again, it has to be the same strike price that we chose for the call that we sold. So now in this scenario, I'm going to pay $4.85 per share. And again, there's 100 shares in each one of these contracts. So I'm going to pay $485 to buy this call option. So I'm going to click on here. Now, as you can see, this right away changed to call calendar spread. This is a call calendar spread. That's what this strategy is called. And as you can see, it's going to be a very cheap strategy. This is going to cost us about $15 or so. $15 for one call calendar spread. And of course, this is a debit trade because we are paying to enter this trade. Our risk here is defined. The most that we're going to be able to lose here is $15. And so the goal, remember, is for the stock to be at or near the strike price at the expiration date of the call that we sold. So our goal here is for this stock, Honda, to be at or as close to $25 on May 21st. Now, so let's actually visually see this, okay? Let's go over to the options profit calculator. Let's actually see how this visually looks so that we can see what our profit or losses are depending on what the price of the stock is, depending on what date it is. So here we are in the options profit calculator. I am going to go under custom and I'm going to click on 2 legs here. So remember, the first thing we do here is we enter the ticker symbol here. So ticker symbol is HMC. You can click on get price, check what the stock price is right now. And again, we're going to sell a call here. We're going to buy a call. We're actually going to do the exact same trade we just set up on Robinhood. So let's start with writing or selling our call. So we're going to click on select option. And again, make sure you're choosing the appropriate expiration date. For the call that we sold, we chose May 21st. We chose the $25 strike, and this is a call. Remember, calls are on the left, puts are on the right. Don't get confused by that. So we're going to click on this. So we're selling this call. We're receiving as a premium $470. Now let's go ahead and buy our call. So again, the call you're buying should have a further out expiration date than the call you sold. So for this one, remember, we chose the 16th of July expiration date. Again, same strike, so $25 strike, same type, so a call. Again, calls are on the left here, so right there. So again, we're selling this, we're receiving $470, but then we're buying this call, we're paying $485. So for the stock price range, I'm going to go ahead and do, let's do 19 to 31 here. So 19 to 31, and let's click on calculate. Let's see how this actually looks like. So this is what this trade is going to look like here. Now let's first focus up here. So our entry cost, $15 net debit. Again, we're paying to enter this trade, and that's going to be $15 that we're paying. That's also our max risk. That's the most that we can lose here, $15. Our max return is $96. And this will be at around $25 if Honda's at $25 on the date of expiration. And remember, this is on May 21st. That's what we're seeing here, May 21st, which is the expiration date of the call that we sold, right? So again, that's why it's very important that the first thing you do is kind of look at the stock and kind of decide what price it will be on the expiration date of the call that you're selling. Because that's the price you want to choose for your strike, right? We said, hey, I think Honda on May 21st will be at 25. That's the strike price we chose. That's the price we want it to be on expiration so that we can make our max potential return, which again in this example is $96. And that would be about a 640% return. Right, so that's a pretty big return here if everything were to work out right. Now we actually take a look at this chart. We can see that there's a pretty huge range where we're still making money, right? And so like we mentioned before, we kind of want the stock to trade sideways. I mean, it can move up a little bit, it can go down a little bit, but for the most part, we want it to stay within this range here. Now, the way this is working, guys, is that, remember, there's theta decay on these contracts. And both of these have theta decay. However, on the call that we sold, theta decay is a good thing for us. On the call that we bought, theta decay is a bad thing. But remember, theta is higher the closer it is to expiration date. And so since the call we sold is closer to expiring than the call that we bought, the theta decay we're making from the call we're selling is a lot higher than the theta decay that we're losing from the call that we're buying. So ultimately, we're taking advantage of that. That's how we're generating some money here. So we are making money here from theta decay. Now, when it comes to risks, there are some risks that you need to be aware of. And of course, the biggest risk here is early assignment risk, especially where the expiration date follows the ex-dividend date, because the probability of assignment increases significantly. So you should always check for ex-dividend dates. Honda pays a dividend. They have ex-dividend date. That would be something I would like to take a look at first before entering this calendar spread. Now, the other thing that we need to take a look at here is what happens once our call that we sold expires. Because this is going to expire on May 21st, and this will not expire until July 16th. So what do we do once this is getting close, once our call that we sold is getting close to expiring? So there's 3 things you can do. First thing you can do is that you can sell another front month contract. So sell another contract that expires before the call we're buying. The second thing you can do, and this is what I usually do, is just close the whole strategy. Just close out the entire strategy. And remember, to close out any trade, all you need to do is do the opposite, the exact same opposite trade. So if I wanted to close out this call that I bought, all I would need to do is sell this exact same call. So I would sell a call that's also expiring on July 16th with the exact same $25 strike. If I wanted to close out of this call I sold here, I would just buy the exact same call with the exact same expiration date, exact same strike price. That's how you close these strategies out. The other thing you can do, of course, is that you can allow the long-term put or call position, so this one right here, to kind of just stay in place by itself, right? You can just let this expire, and then this one you can kind of just let it play out by itself. Hopefully it kind of works out in your favor after that. So again, I usually like to just close out the entire strategy. And I always think it's kind of important that you close it out yourself. Never let Robinhood close it out for you, because I've seen a lot of problems happen that way. So this is the calendar spread, guys. And again, you can kind of take a look at here what your potential profits are. So kind of mess around with this. Definitely use the options profit calculator. And if you have any questions, feel free to leave them in the comments section below. Check out the Discord link to that in the description below. I hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.